Live. Welcome to the Thursday night live stream. Happy Veterans Day to all of our vets out there. Lots of respect to you. All right. So today was one of those days that, as I like to say, the market sent you a signal that there was trouble brewing. And we're going to go over the intraday chart. I'm going to mention what I mean because the event that took place today set the stage for probably a continuation pullback here in the equity markets. We knew it was coming. We've had a straight shot up. We began reloading to the short side. And today we added more. And do I think that we're going to crash? Probably not. I think that we're range bound right now. So let's get the housekeeping out of the way. Let's go through the economic data. Let's go through saying hello to people. Let's let people enter here, and then we'll talk about what the heck is going on out there in the world of global finance, and it is global. So let's first kick it off with first, how's my audio? And I am in fact live. Okay, that's good. Jody, look at Jody, number one out of the gate tonight. Very impressive, very prompt. Franklin, welcome. Larry, is stagflation worse than recession? Answer is yes. It's harder to manage. Yeah, I'll agree with that because stagflation between a rock and a hard place, whereas recession, you have levers that you could pull. And you're basically reversing the bubble that you just blew up. So, yeah, I agree. Yoga Mac, hey, where you been? I messaged Bob on Twitter tonight. You get a yoga. Okay. Seymour Rivers, thank you, sir. Thanks, Mark. Paul, good evening to you. Yoga Mac, all contrarians don't underestimate momentum. Very, very true. Trader Isaac, welcome. Okay, folks. If you're not a member of our small account club, if you have a small account, even if you don't have a small account, we have good conversation, private live stream starting in 2024. They're public now. Link below. Make sure you get invited to our private live streams. No charge, none of that stuff. And what else? If you are new to technical analysis, the jargon that I use in terms of technical analysis, my top 5 favorite candlestick patterns, linked below, free of charge, 5-part video tutorial. Let's get started. Let's talk about the economic data this week. And I got to be honest, there's not much. But they felt it necessary to send all of these Fed heads out this week. And they really didn't say much. Even Powell today, there wasn't much to say. The reaction by the market took place before Powell spoke. So really not much to talk about. Initial jobs claims today. I didn't look at this one. Came in lower than expected. Tomorrow we have, oh God, there are more of them coming out tomorrow. Look at this, Veterans Day, and they feel the need to speak. We are so screwed. All right, so taking a look at the PE multiple, this is after today. Markets closed down. PE multiple 29.43. Now, it being Thursday, we have the assets under management, basically the Federal Reserve's balance sheet that gets announced, and it declined slightly, but the rate of change of the decline dropped off dramatically from last week. So we've seen this before where you get a slow rate of change, and then it picks up. So looks like they're doing a stair step down. So I want you to keep this chart in mind. This is a very, very important chart for tonight's conversation because what drove equities today were bond yields. Now, let's come back to this. I wanted to go in a different order. This makes sense. Okay, good. So off a zero hedge, there's a crisis brewing. Powell and piss poor auction sparks chaos in credit markets. Crypto soars. We're going to go to crypto in a moment. So they had a bond auction today, and it did not go well. It was a very, very, I think it was a 30-year bond auction. So long dated maturities, the Federal Reserve does not have a lot of influence over those longer dated maturities. And that bond auction, the bond vigilantes showed up. They said, hey, yo, no more of this cheap money. No, we want more. We want more of a yield. You got to pay up. So it did not end well. And when you move forward here and you take a look at the historical nature of what happened today, I'll just read this off. Complete disaster. That's the only way one can describe today's 30-year auction, which many expected could be challenging after a mediocre 3 and subpar 10-year auction earlier this year. But nobody expected this. Here's the crux of the problem. The bond priced at a high yield of 4.69%, which was below last month's 4.837 and shy of April 2010's highs. But more importantly, it tailed when issued by a whopping 5.3 basis points, which was well terrible, because as shown in the chart below, this is the biggest tail on record going back to 2016. So I haven't looked at this chart. Wow. So much for demand. This should be yields, treasury yields, yes. My God. Folks, this is only a couple of minutes. In a couple of minutes, this is what happened to the treasury market. Sorry. I had halal tonight. Very good, but very salty. So when you take a look at what happened intraday, this is the 10-year yield intraday. Overlaid in gray here, I have the S&P 500, and here was the bond auction. And it just ripped. These are bond yields, ripped through the ceiling, and the S&P 500 just went into free fall. And that's all she wrote. That's all she wrote. So why did the stock market continue to drop off after the bond yield ripped up higher? Well, when you take a look at the December, this is the Fed Watch tool. Basically, this is the market participants saying, hey, this is our bet for Federal Reserve rate hike in December, January. We're going to look at March as well tonight. And as of last night, the probability of a Fed rate hike in December was over 90%. That dropped back to 85%. Not a big deal. There's not going to be a rate hike in December. But where things get wonky is when you get further out. January. Last night, there was a probability of 82.9% no rate hike in January. Still, very improbable that we're going to get a rate hike in January as it stands right now, but we don't know what the economic data is going to bring. Here's where it gets a little bit more iffy. When you go out to March, and we've been talking about this with members all week on Market Wrap, and I've been pointing out that this number here, the probability of a rate cut, remember, the markets have been rallying because the dollar is pulled back, yields have pulled back, and the expectation that the Federal Reserve is now paused, and now the markets are pricing in a cut as soon as March. Well, all of a sudden, that began to dissipate, and Powell kind of put the nail in the coffin with his comment later on after that bond auction, because yesterday, this was at 18.2%, the probability of a rate cut. That was chopped down pretty sizably by the end of business today. Now, taking a look at the probability of no change in March, that went from 68.2 to only, I shouldn't say only, to 67.1. It went down. What changed? What changed was the probability of a rate hike. It went from 12.9% to 17%. So what you're seeing here is the delusion that the bulls have that the Federal Reserve is going to cut rates right away. That delusion is being pricked. It's like a bubble getting pricked, and they can't handle it. That does not compute, and their wiring gets set off. So, again, it doesn't take a genius to figure this out. All you need to do is, hey, I'll share this with you. I mean, it's pretty simple. And then you take your logic and you say, okay, does it make sense what they're saying here? Are they going to cut rates in March? I'm not seeing the reason why they would do that. The economy is not good, but it certainly doesn't warrant rate cuts. All they're doing is normalizing interest rates at the low end of their historical range. But the markets, because we're so in debt, we have so much debt, the government is just sucking the private capital out of the economy to send that money offshore into institutions who hold our debt. And add to that the fact that they are increasing spending, and you have a recipe for disaster here. So Jay Powell is not in a good spot. Now, before we move on, I'll take you back to this chart here. So the bond auction did not go well. So who is it that is out there demanding more yield? It's not the Federal Reserve. The Federal Reserve is selling or allowing maturities to expire. So they're not buyers of treasuries. It's the private market. It is overseas governments that are buying this debt. The bond vigilantes are out there. And if you're not familiar with what the bond vigilantes are, those are the bond traders that went to the market back in the 1970s and said, listen, you got Vietnam War going on. You have the Great New Society that Lyndon Baines Johnson, arguably the worst president in history. All this is going on. Then Nixon took us off the U.S. The gold standard, and the bond vigilantes said, wait a minute, what are you doing here? This is nuts. Here we are again. Rinse, wash, repeat. So at some point in time, the feds are going to be knocking on the Federal Reserve's door and saying, hey, man, we got an election coming up here. You got to start buying and cutting down these rates because the markets are not doing well. Inflation continues to rise, and you got to do something. So I think what they're going to do is they're going to sacrifice the U.S. dollar. They're going to try to get the dollar to drop. That will drive up inflation, but allow equities to rally. So keep an eye on the U.S. dollar. We're going to go over that in a minute. I believe it was up today. So they're going to have a job on their hands to get the dollar down. So moving on. Endgame, interest rates on U.S. debt skyrockets above $1 trillion for the first time ever. Back in July, when we first looked at the unprecedented horror show that is the U.S. budget deficit and concluded correctly long before Q2 quarterly refunding announcement that the debt issuance was about to explode and yields would soar. Pause there. Keep in mind that the Republicans have been in control of Congress or the House of Representatives since January. I'll continue. We warned that the debt Rubicon was about to be crossed and U.S. debt interest payments are about to hit $1 trillion. Fast forward to today, the end game has apparently arrived according to the Treasury's own calculations. Total interest is now over $1 trillion. Let's put this into context. Our budget, excuse me, our defense budget is about $860 billion. Our debt payments are in excess of our military budget. That is unsustainable. So, for those wondering, are they going to try to push digital currencies, CBDCs? Oh, yeah, they want that. They want to be able to take money out of your account, pump it into the economy. So that way they don't have to cut interest rates. They want control of your 401k. They want control of private money. This is why you're seeing a push towards taking away private rights, citizens' rights. This is the end game. They are broke, but they don't want to lose power. And the ability to spend money is really only power that you have in Washington. So, what's the response? Forget about the Democrats. Forget about the Democrats. They're doing what they do. They're children. They're children, but they're nefarious at the same time. They're ignorant and arrogant. Whereas the Republicans are just incompetent. So, government spending as a share of GDP just hit the highest on record. So we have the House of Representatives controlled by the Uniparty. Yet our GDP, our spending relative to GDP is at the highest ever. How this gets resolved is not going to be pretty. It's just not going to be pretty. You have a couple of ways of resolving this. One, government cuts spending, but guess what? That's going to be a tax on a lot of individuals because they're going to have to go after entitlements. So there's going to have to be means testing. They are going to have to be far more aggressive with onshoring manufacturing. They are going to have to stop the siphoning of private capital out of the private sector so that businesses can reinvest and grow the GDP. If you grow the pie 5-6% a year, well, then that naturally, as long as you're not spending as much as you were, spending has to get reined in. This automatically begins to roll over. So you can grow your way out of it like we did after World War II. We grew our way out of debt. Our debt to GDP back then we're worse now, but it was well over 120% of our GDP. But we grew out of it. We were still a creditor nation. Now we're a debtor nation. We gotta go back in time, and we cannot be importing oil. We need to produce it here. Everything's got to be produced here. Our trade deficit has to come down, and these forever wars have to stop. I want to play this. Let me make sure that I shared my audio with you folks. Yes. Let's play this. No, no sound on the video? Ah, I'll replay it. Hopefully you could hear it this time. You should have been able to hear that.
This is how we get our country back. We need.
Swami, let me turn to you. Please make your case. Why should you be
Can
the
you hear it or
nominee,
no?
not the former president?
I think there's something deeper going on in the
All right.
Republican Party here.
It's not working. Oh, it's good now. All right, good. Thank you. So you can hear him, Vivek. Okay, good.
And I am upset about what happened last night.
Now there's no.
We've become a party of losers at the end of the day. It was a cancer in the Republican establishment. Let's speak the truth. I mean, since Ronna McDaniel took over as chairwoman of the RNC in 2017, we have lost 2018, 2020, 2022, no red wave that never came. We got trounced last night in 2023. And I think that we have to have accountability in our party. For that matter, Ron, if you want to come on stage tonight, you want to look the GOP voters in the eye and tell them you resign, I will yield my time to you. And frankly, look, the people there cheering for losing in the Republican Party. Think about who's moderating this debate. This should be Tucker Carlson, Joe Rogan, and Elon Musk. We'd have 10 times the viewership, asking questions that GOP primary voters actually care about and bringing more people into our party. You think the Democrats, and we've got Kristen Welker here, you think the Democrats would actually hire Greg Gutfeld to host a Democratic debate? They wouldn't do it. And so the fact of the matter is, I mean, Kristen, I'm going to use this time because this is actually about you in the media and the corrupt media establishment. Ask you, the Trump-Russia collusion hoax that you pushed on this network for years, was that real or was that Hillary Clinton made up disinformation? Answer the question. Go.
Mr. Ross.
Sorry. This is how we get our country back. We need accountability because this media rigged the 2016 election. They rigged the 2020 election with the Hunter Biden laptop story.
Mr. Ramaswamy,
and they're going to rig this election.
Your time is up.
Accountability.
Let me turn to Governor Christie. Why you?
So he did a really nice job there, and I'm getting this sense that things are. I'm kind of getting more optimistic. Romney's not running anymore. It's very, very early in the game, but I'm becoming more and more optimistic that we have an emerging leadership here that is down the road. Unfortunately, they're going to have to right this ship. This puppet of a president that we have is not going to do it. If they elect any one of these other candidates on this stage, they're not going to do it. They're not leaders; they're puppets. So hopefully we have an upset here, and we get a Vivek. We get a hopefully Ron DeSantis who gets his act together, or Trump. But something's got to happen and happen very, very quickly. And this uniparty needs to be annihilated. They have to be removed. And I think that the removal of what's his name? Thank God I forgot his name. McCarthy was a great first step. It was only the 52nd time there's been a change in Speaker of the House. So a big event. All right. So on the inflation front, I thought this chart was interesting. This goes through 2022. So let's just put that into context. But the average family health insurance premium in the U.S. is up 249% since 2000. The biggest beneficiaries of this massive increase, health insurance companies, UNH, the largest U.S. insurer, was up 4,120% since 2000 versus 340% gains in the S&P 500. Think about that. Think about that. So what I think is going to happen with if I were coming into office, I would I would try to pass whatever legislation there was possible for health insurance. No, not to be run by the states. I think that you need a national marketplace, and that would help drive down the cost. But I think it's got to be not nationalized, but a national competition for health insurance plans. All right, so this continues to grow. We report this every week. Banks' willingness to lend to consumers approaching recessionary levels. It's approaching. It's not there yet, but conditions are tightening, and we've known this. This is no great shock. So this is the tightening of credit conditions. M2 money supply is the tightening of credit conditions. Rising interest rates is a tightening of credit conditions. So it's just showing you how the U.S. consumer continues to get battered. Now, what else is going on is that, and this was brought to my attention on Sunday night, I believe, by one of you viewers. I forget who brought it up. It was WeWork, and I knew that they were renegotiating leases. I had no idea that they were this close to Chapter 11, and it's done. Bankrupt WeWork to immediately dump 40 New York office leases. This is huge. This is huge. So the impact of the commercial real estate crisis continues to feel ripple effects through the economy. So what's going to happen now is that the vacancy rates in these buildings, in this case, New York City, it's only going to go up. What does that do to the value of those properties? The values go down. What happens when they need to roll over their existing debt to help refinance those buildings? Good luck. A lot of those buildings, the owners are going to take the keys, hand them back to the banks. And here is a chart. Commercial real estate defaults have been rising. This includes two types of loans, under 50 million, over 50 million. Defaults on both these types are aggressively moving higher. Businesses that bought commercial real estate, like office spaces, are struggling to generate consistent revenue. In a higher for longer environment, which we are in, refinancing costs are going to put additional pressure on these businesses. This won't end well. You're going to have to have bankruptcies. It's long story short. What happened in 2007, 2008, 2009 in the residential market is going to happen in the commercial real estate market. It's as simple as that. But out of the ashes rises the phoenix. There is going to be another side to this. So the worst thing that Powell could do right now is come running to the rescue, throwing out life preservers and cutting interest rates so that this doesn't play out. That's what's been happening ever since 2000, the dot-com bubble. We've been in bailout mode. Companies need to fail. I don't like saying that. That means jobs. But they need to fail. So that way, the allocation of resources from the weak ends and it goes towards the strong and the up-and-coming entrepreneurs that are going to develop new funds. They're going to develop new businesses. So unfortunately, these banks, these real estate trusts, they're going to have to go under. And with that, there's going to be opportunity. You're going to have a price point at which bargain hunters are going to step in, see value, and the free market takes over, and you'll see a increase in commercial real estate prices. But right now, we are teetering at the precipice of where we were in 2007. Let's do some comments here. Oh, about Vivek? Yeah, he's savage. He did a good job last night. Corey agrees. TZ Bird, Rona Romney's a mole for the DNC. Yeah, no doubt. Trump, Vivek, 2024. I wouldn't mind it. We whack. I don't even think it's trading anymore, is it? In the 70s and 90s in New York City, they would just arson the building to get. Oh yeah, it's so true. That happened in the South Bronx. Uh, for those of you that don't live or know New York, downstate New York, the South Bronx, it's gotten better, but it's not great. But back in the 1970s and 80s, uh, they would torch those buildings day and night, day and night. That whole place was on fire. It got to the point where the vacant buildings, they used to put paintings in the windows with flower pots and curtains just so they didn't look that bad. And people would come in and buy the buildings, which ultimately they did. And that was the free market that stepped in. But what did you have? You had Giuliani that came in, made it right for businesses to come in, make the investment. And when you have good government, rule of law, you have capital that follows. And it'll be the same thing next time. And 10 years from now, you'll be looking at some of these real estate investment trusts, which are dirt cheap right now and probably going to get cheaper. They're going to be a bargain. You're going to look back and say, Jesus Christ, I wish I would have bought them then. But I think they're going to get cheaper. All right. What else do we have here? So I mentioned earlier that, I'm not doom and gloomish here. I think that there is going to have to be a day of reckoning, but is it right now? I don't think it is. I don't think it is, because when you take a look at the yield curve has begun to re-steepen again. We've retraced the vast majority. In fact, this is close to being an outside reversal bar, aka a bearish engulfing of the body of last month. And sure, this could rally back. It's early in the month, but we're only day 9 into November, and this is a horrendous reversal bar. So can equities rally in this environment? Yeah, they can. I worry about the steepening, not about the inversion. So if we keep pulling back here, can equities find ground? Yeah, they can. They can. So let's now go into the weekly charts and let's talk about how we are looking to close out the new trading week. In 2020, the total number of registered lobbyists who have lobbied for the health sector in the United States amounted, nearly 3,300. That's crazy. And they have a big fat checkbook with them too. We'll go over gold. Bob, can you take a minute and analyze volume on SPY for UN? Popped by 67 million to 80 million. Yeah, I could do that. Yeah, we'll go over it. Talent, where you been? Good to hear you, brother. All right, let's get to it. We don't want this. We did this. We don't want that. We don't want that. We did that. Now we're going to go over the weekly charts. 10-year yield weekly view. And we're up. We're holding the lower band of support. One trading day left to go, daily view. Now remember, this is important because this is what rocks the stock market if it continues to press up higher. Now, am I convinced that this sell-off is done? No, not yet. We just may end up rallying to fill the gap here. And then we may roll back over, but it certainly was a bullish day today and not bullish for equities. I think that we are going to get a continuation move up higher. But we don't have a breakout yet. So I think that what's going to happen, bare minimum. Here, let's just do this. Get rid of this. We'll keep that there, and we'll move this down. Perfect. I think we're going to fill that gap. And the test will be at 48 or 4.8 on the 10-year yield. Now, looking at the TLT, we tried to break out last week. We tried to break out this week. One trading day left to go. Maybe it'll happen. Maybe it won't. But I think that what we need to do here is that we need to do a retest of this breakout point. That means that you're probably going to see TLT back down below 85 within the next couple of weeks. Daily view. And it too was probably going to come back down and do a retest of this gap that opened up here on the 2nd of November. And that would be, you're probably going to do a retest of between that gap and 84.55 on the TLT. Tips, Treasury inflation protected securities down on the week. So to the question that Paul had earlier, what happened to gold? Well, if you have yields rallying, and not that yields were rallying when gold began to sell off, but there was a concern about deflation. And if you get that concern in the market, albeit temporarily, you can get a pullback in tips. You can get a pullback in gold, silver, all of those hedges against inflation, they pause. Add to that the fact that you had a rally in the Magnificent Seven names, and who the heck wants gold? Who the heck wants silver? Nobody. Nobody wants the gold mining stocks. They wanted Microsoft until today. We shorted it. They wanted Apple till today. Not looking good anymore. So now we may see a little bit of life come back into those names. The only thing that may hurt it is the dollar. Weekly view. The dollar is up a percentage point on the week. Now, last week we had a bloody sell-off, but we got no follow-through to the downside this week. This is what really took the air out of gold. Gold traders thought for sure we were going to get a follow-through week to the downside this week. It didn't happen. So I got suckered in. I got suckered in on Friday. I bought, well, actually last Thursday, I bought GDXJ and I sold additional puts on NUGT. I'm okay with it because we didn't go jumping in all with both feet. We just added in increments. So this in one picture is the proximate reason of as to why you're seeing gold pull back, silver pull back, miners pull back, tips pull back, etc. Strong U.S. dollar. This is what I mean by they need to kill the dollar. The government needs to sacrifice the dollar. Unfortunately, we import a lot of stuff. So if the dollar goes down, that means inflation goes up on imports anyway. Euro, bearish reversal bar on the week. Yen, rebroke down this week. One trading day left to go. Volatility. Now, got dry eyes. Now, volatility rallied on the week. We are up 2.5%, a little bit more than that. Daily view. Outside reversal bar. Bullish key reversal. Again, for those not familiar with what I'm talking about, link below, 5-part video tutorial. My top 5 favorite candlestick patterns. This is one of them. Momentum hooking up. I mentioned to members that we were very oversold here and that we're probably going to hook up. As a matter of fact, this morning, I did a morning note. Here it is. Here was my morning note. I put this in the members Slack forum. When I get up really, really early, and I just wanted to outline because I knew we were at a precipice. So these are the observations that I had this morning of resistance levels on the Qs, daily, 15-minute, VIX, support and resistance levels, observations of over, and I mentioned this morning, daily Q stochastics overbought, 15-minute Qs overbought. Here's our support levels, resistance levels and support levels. We barely held on to support level number 1. We're actually below it in the after hours session, but technically we closed above it. And I said going into the new trading day, it was my sentiment bullish with an eye on a reversal day. What do? We opened up, we reversed lower. That's what we do here. That is our job, is making observations and planning it out. I mentioned this morning also, watch MSFT as it is extended yet nearing all-time highs. A burst up is a reversal opportunity. What do we get? A burst up reversal opportunity. We went short. We're going to go over that chart in a moment. Dow Transports pulled back on the week. Let's go to a daily view. The transports are our canary in the coal mine for the equity market, as goes transports in general, goes equities. And you could see that we had a big breakdown today. Volume was light, but the price action was terrible. Dow Jones Industrial Average, we're still holding support. We did put in a new weekly higher high, but the 20-period weekly moving average in green is acting as resistance. But does this chart say to me, does it scream to me, I got to go short the Dow Jones? No, not at all. The S&P 500. Weekly view. Again, another chart where it's not a screaming short. Yeah, I have short positions on. I'm not aggressively short. We have a lot more liquidity today. We closed out some pretty large options trades. Daily view. That's not a daily view. Daily view. There we go. So again, another outside reversal bar, a bearish engulfing, and we broke down below support. Now, Yoga Mac had a question here. Let's revisit it. Can you take 1 minute to analyze volume on SPY before you end? Pop from 69 million, 80 million in volume between 4 and 415. Well, I think that what you had was you just had traders adjusting their book. And you did have some short covering here. This is a 15-minute chart. Let's go to a 30-minute chart to encompass the time frame that you're looking at. You know, for the time frame that you're looking at, what you saw was a lot of indecision, a lot of backing and filling. I would argue that we're probably going to pop up tomorrow because there's a lot of compression here in this chart. Take a look at this volume. Like you mentioned, we had in excess of, 13 million shares traded? Almost 11, sorry, about 11 million shares traded, the final half hour of trade. And we didn't change much from the open to the close. What that tells me is that there's a tug of war between bulls and bears. You had a squaring off positions. Shorts covered, and large institutions, they lightened up, right? They had a nice rally. Now they're booking some profits. Shorts, they caught a nice trade here. They're booking profits. So that's my take on the price action at the close. Now, as for the Qs, this I'm short of. This is a daily chart. Let's go to the weekly chart first. So technically, week on week, we had a continuation breakout, but we were stuck at the 373 mark. Again, I'm going to take you back to resistance. 273.74 was the number I was watching. High of the week was 374.80. So we went through that resistance level, couldn't hold it, and got rejected. So this is why it's so important. If you're not going into a trade, or if you're not going into each day knowing where your support and resistance levels are, you're a blind man walking out around without a cane. You got to know that before the market opens. You got to know it. All right. So please make sure you're doing that. If you're an active trader, know your support and resistance levels each day, because they change. So Qs on the week still don't look bad. They're up over a half percentage point. Where I get concerned here is the daily view, and we broke support today. Again, another outside reversal bar. Maybe they're going to gap this up tomorrow above 370. What do I know? Well, 373. I don't know. Maybe they will. I'm not that smart. But the probability of a continuation pullback here is very, very high if the dollar moves up and yields move up. In fact, I would argue that it's almost a guarantee. If both of those move up, Qs go down. XLK Technology was looking really good earlier in the week, but like everything else, it got too far ahead of itself and reversed. Semis, now they're trading well off the highs of the week. Daily view, bearish key reversal bar. It's a short. We break the new daily lows. It's a short. Let's check out NVIDIA really quick. And I want to take a look at Microsoft, because what they did with Microsoft, to a lesser extent NVIDIA, is that Microsoft is the largest component of the triple Qs. So what they needed to do was to get NVIDIA going. They needed to get Apple going. Apple is, God darn it, is a competitor for the largest position in the triple Qs with Microsoft. You need these two to keep the Qs moving up higher. And you saw a reversal day today on Apple and on Microsoft. It reversed. Again, part of my note this morning to members, spiking NVIDIA pre-market, 470 resistance on NVIDIA. Let's go back to NVIDIA. They spiked it as high as 482.30 and then reversed. All right, LABU. Let's go to comments first. Reflection. If you're losing money with your strategy, change your strategy, but how does question to the opposite of what you tried to do? Yeah, I think that one of the problems that traders have is that they develop a strategy that works, and for whatever reason, I'm guilty of it. For whatever reason, we tend to get cute, if you will, and we tweak it, and we kind of forget what was working. And when that tweak that we did to our strategy doesn't work, all of a sudden our confidence gets hurt. Then we overtrade. And then all of a sudden you start going down this spiral of poor psychology rather than stepping back and saying, okay, let's evaluate the trades. And I try to keep a journal. Here it is here. I just make notes to myself, what I'm doing right, what I did wrong, and I reflect back on it. I don't talk about it all that much, but it's really important to do. And in a way, what you're doing is when you're journaling something at the end of the day, suppose you didn't have a good day, and you go back and you start reviewing your notes, and you're able to pinpoint a point in time in the day or the week, if you're doing it on a Friday or Saturday, you take a look back and you say, Jesus Christ, I'm so happy I made that note, because now I know don't do that again. Because sometimes you forget. You're just thinking about the loss or the bad behavior that you displayed while you were trading. You didn't put enough thought into documenting it and saying, okay, there's a trend here. I remember doing this a few days ago. I did it again. That doesn't work. Slap yourself on the hand. Don't do it again. Whether it be you're getting too big with entering your trades, you're not entering it if you're getting short at a resistance level, you're not waiting for the appropriate bearish reversal by the appropriate signal by the market. Whatever it may be, there's so many variables, but your strategy need not be complicated. It best be simple, but the more you complicate it, the more you diverge, the greater the risk that you're going to go down the wrong path. But if you journal your day, think about it, just journal your day and reflect upon it, and it'll pay off. It really, really will. I'm a big believer in that. Thank you very much, Yogi Back. Good to hear you back. I haven't seen you in a while. Glad you're back. Yeah, Corey, I'm glad you did that. I liked the trade a lot, and I was kind of kicking myself last night. Let's bring Adobe up, and I'll talk about the trade here. I was thinking about, I couldn't put it on because it was after hours, and I wanted to do an options trade because I was looking at the daily chart, I believe it was. Yeah, it was the daily chart of Adobe, and they were moving it above the 2 standard, which is no big deal. But then I saw the price action here, and I saw this trajectory higher. And let's illustrate what I was looking at, because I could do it in my head, but a lot of people can't. So let's illustrate what I saw. Actually, this is the chart I was looking at. We're above the 2 standard deviation and the Keltner channel. So to illustrate the unsustainability of Adobe, we were hugging the upper band of resistance above the 2 standard, above the Keltner channel, above stochastics, and it was ripe. It was ripe to fall, and I wasn't going to short it. What I wanted to do was to sell premium, and this is why I was kicking myself. I was looking at Groupon destroyed after hours. I love Groupon. If you take a look at, if you're an option seller, you want to find options that are expensive. And you can see here, the current IV percentile is very expensive. The options on Adobe. Usually you don't see on a large cap stock, which is in a very strong uptrend, an IV percentile this strong. You just don't see it. And it was an opportunity, and I wanted to execute early this morning. It wasn't at the time. I didn't put it in my morning note. I should have. And by the time I got to look at it later on in the afternoon, it was already down $6. And I'm my own worst critic. So I just started kicking myself. You acted. Congratulations. I may act tomorrow once I stop feeling sorry for myself. I found SOXL today, which is ETF, popped nicely. Oh, that's the short ETF of the semis. Yeah. Outstanding advice for keeping a trading journal. As a professional tech writer, editor, and prompt engineer myself, taking notes and journaling exponentially improves my thinking and my life. No doubt about it, because what we're doing is I think I'm going to blabber on here, but I really think it's worth the conversation, is that and engineers happen to be just naturally good traders, especially options traders as well, because they know probabilities and statistics. But when you're looking at charts, constant charts, numbers, as I forget what the guy's name was in Wolf of Wall Street, all this above the shoulders mustard stuff. You have so much data going through your mind that at the end of the day, you're like, Jesus Christ, enough is enough. But if you're able to take your journal and go back and again reflect and say, okay, I thought enough of that note to jot it down. And most of the time when I do review the notes, I get a sigh of relief, because at least I made the mistake, but I'm allowed to let myself off the hook because I documented it, and now I may not repeat it again. Doesn't always necessarily mean I won't repeat it again, but at least I'm cognizant of it. And if it goes awry, I know to cut the loss small, and it has its extra added benefits, even if I do repeat the error again in the future. And the most common error that I make, I have a rule, and Franklin will call me out on this, and that's okay. That's fine. I have a rule of not opening up new trades before 3 p.m. in the afternoon. Why? The reason is that you have no idea how they're going to close the market. Zero. The two most active hours of the day are the opening hour, the closing hour. Everything in between is consolidation of the opening hour and a setup for the closing hour. It's as simple as that. So if you begin to buy at noon, God forbid at noon, 1 o'clock, 2 o'clock, and you're anticipating that huge rally on a stock to hold at the highs of the day, and you buy it there because it can only close strong, that's the day it reverses on you, or that's the day it sells off into the close. So I would strongly encourage, that's my number one. If there's any error that I do on a consistent basis that I repeat, but I hold myself accountable by coming here live in front of over 20 people and saying, this is my development opportunity as a trader. And this week I did pretty good. Okay. Generative AI prompt engineer. Wow. I hate the terminology, but data scientists consider me an engineer since I test and troubleshoot their language models. Wow. Wow. You ought to give me a ring if we could work on charting study. I'll be interested in doing that. I have a couple of things in the works right now for Think of Swim, but I would love something more unique. So cool. That's good stuff. Thanks for the info. Okay, let's bring this to a halt because we're already at 6:59. I can only go over members tonight. I have a couple of charts to go over. We'll leave it off here with a couple of charts that I do believe that are important, and that is in the oil markets. Oil is breaking down. This is another reason why you're seeing gold pause here, because I mentioned earlier a worry about deflation. Well, if oil pulls back, that's deflationary across the board. CPI next month is going to reflect potentially lower oil prices in the month of November. And that'll help even at the core, on the headline CPI, and it'll help at the core as well. Gasoline prices pulling back. That's deflationary. Good. Nat gas pulling back. Good. Not good for, I have a trade here on it, but we stayed small. We stayed small. Bitcoin telling a massive story here. A major continuation move up higher on Bitcoin. I think it's BlackRock filed for an ETF on Ethereum, and Bitcoin is running up into the gold. So again, as long as you have the US dollar, which is rallying, and you have yields pushing up higher, but that's a lesser extent. Yields are a lesser extent a hindrance for gold. Gold and the 10-year yield can rally in tandem. They did it in the 1970s and early 1980s. What didn't rally in tandem with gold and the yields in the 1970s, 80s was the US dollar. The US dollar went like this, while gold and yields went like that. So we bounced on the week, but yes, gold is not doing well so far in November. The day, though, is pretty good. I think you should monetize your Twitter account, Bob. We'd love to collaborate, can help you with e-courses, e-books, as well as guides. Yeah, I would be interested. I'm a horrible producer. I am engulfed with charting on the weekends in particular and doing the video. So would love to collaborate. Yeah, let's connect. No doubt about it. I would be very, very interested. Yeah, I'm dollar cost averaging it on Bitcoin. So I've been doing it for over a year now, and it's really paid off. Okay, Jody Meta. I only have time for a few tonight, folks. Go to the members area. We have Wendy, Clorox, LABU, GEN. I think, is that Genrac? Could be wrong there. And we'll do Meta for Jody, and we'll call it a night. Let's get to it. All right. So first up, we have Meta. Now, I sold my common stock for profit after hours last night. What the heck is going on here? I'm not sure what's going on here with TrendSpider. It's not doing well. Let's go to stock charts. Okay, so we'll go to the weekly chart first. Weekly chart still looks good. Let's get rid of the SPX. It still looks good, but I was concerned about the price action yesterday. So I sold the shares after hours. And it wasn't the daily chart that concerned me yesterday all too much, because we did flash a reversal bar, a little bit of selling off of the highs. What concerned me about Meta was the 15-minute chart and how we closed on Tuesday. Oh, no, sorry, Wednesday. And we saw a bit of a fade, and I didn't like it. So I decided first out, best. Actually, there's a 30-minute chart. I decided first out, best out, and exit stage right. And I'm glad that we did. I still have a strangle here on it, just generating cash flow. Do I think it's going to press lower? It's probably going to press lower. I don't like the topping action here. This is a weak rally on Tesla, excuse me, on Meta. This is what a strong rally looks like. This is what a short squeeze looks like. And it's not a very, what's the word? It doesn't have a conviction. So I think that this could easily break. But you do have a lot of support down below at that $300 support level. Volume has been very, very light. So I'm not a bull on Tesla. Maybe, excuse me, Meta. I keep doing that. I'm not a bull on Meta right now. I think it pulls back with the rest of the Qs. If in fact they do pull back, what do you need to have the Qs pull back? You need a rising dollar and or rising yields. Let's go to Wendy's picks. Clorox. This is a consumer staple. We'll go with the weekly view first. A strong rally, but I think that this is a rally that is to be sold up and into the 21 period EMA here in orange, because that's probably going to coincide next week with the 135 mark. You have a lot of resistance here. In fact, we closed right at it. Or we hit it and we backed off, I should say. Right there. So they may try to pop this up again next week. I'd be a seller into that 21 period EMA. Watch for a pullback and a retest of 132.90 if, in fact, we do make it up that high. And look for it to hold out next week above that mark. If it does, and we begin to consolidate above that level, well, that's a good thing because you have a whole lot of support at that level. But it needs to close there on a weekly time frame. I doubt it's going to do it this week. Maybe it does. Maybe it doesn't. But what you really want to look for is a rally up to the 21 period moving average, a pullback, a retest of 132.90. I'd be a buyer. Then if it appears ready to close above that mark by end of business, not this Friday, next Friday. Let's go to a daily view. We're extended on momentum, stochastics. Can it press up higher? Sure. Volume is good. So it's a nice rebound off of a very oversold condition, but these are generally finite. You're going to need a pullback, higher lows, a base to get built. You're not going to get a V-shaped recovery here. Too much damage has been done technically. So I would not be a buyer here. Not yet anyway. LABU. Let's go to my saved chart of LABU. Weekly view. Now, we broke out last week. You did a complete retrace this week. Technically, we're trading down back into this trading range, which is bearish. One trading day left to go. If we move up higher tomorrow, I'd be okay with nibbling a bit more here. Daily view. Oof, brutal retracement. This really needs to get negated. We need a pop up higher and a close on the week above $2.75. If it doesn't do that, we could take out the lows of $2.46. There will be, thank you, Franklin, for your advisory. They are going to be doing a reverse split on LABU and LABD and a couple of other ones, and for his Franklin as well. Thanks, Franklin. Have a great night, my friend. See you tomorrow. I love your icon there. Cool. Yes. Reminder does. Yes. Thanks for that, Franklin. Yep. Okay. So LABU, wait for a close above 275. Don't buy it right now. If it continues to fall here, we could take out the lows. So I'm not a buyer yet. GEN. Oh, this is Gen Digital. Let's go to a weekly chart first. I'd be a seller here. I think that you've got a nice rally, but you have a lot of overhead supply at this range, including a couple of moving averages. Right now, we're above the 50-period moving average. You need to close above 19 and then a base to get built. We close right at 19. I'm not a buyer here. I'd probably sell this rip. Let's go to the daily chart. We're very overbought on a daily time frame on momentum, and the stochastics are very extended. When you get the price action of a stock, commodity, whatever you're trading cupcakes, and the price of a cupcake is leaning up and into its third standard deviation Bollinger Band in red, you do not buy, you head for the hills, you sell. So this is a sell all day long. I would be out of this. You're going to get a retracement here. So be very careful with initiating new trades or staying long this, folks. Thanks for being here. Like, subscribe. Happy Veterans Day. Have a profitable trading day tomorrow. Have an awesome weekend. Don't forget, link below for our small account club. We'll be meeting on Saturday. And don't forget our 5-part video tutorial, my top 5 favorite candlestick patterns. Link below. Take care. Have a great night. Be well.